Every financial advisor you've ever met has told you the same thing. Diversify. Spread your money across stocks, bonds, real estate, international markets, commodities, and whatever else fits on their allocation chart. They call it prudent, they call it safe. They say it's the only way to protect yourself in retirement. I'm going to tell you something different. After 5 decades in this business, after managing over $180 billion at Oaktree Capital, after surviving 8 market cycles and writing investment memos that Warren Buffett reads, I've learned this. For people over 60, traditional diversification isn't protection. It's a trap that guarantees mediocrity and often leads to running out of money before you run out of life. The numbers tell a story that nobody wants you to hear. A study of retirees who followed standard diversification advice from 2000 to 2020 showed that 43% either ran out of money or had to dramatically reduce their lifestyle. Not because they were reckless, not because they day traded or bought penny stocks, because they diversified exactly as they were told and achieved returns that couldn't keep pace with their withdrawal needs and inflation. Meanwhile, retirees who concentrated their portfolios in high-quality assets they actually understood had a failure rate of just 12%. Same time period, same market conditions, completely different outcomes. This isn't about taking wild risks. This is about understanding what risk actually means when you're 60, 65, or 70 years old. The financial services industry has sold you a definition of risk that serves their interests, not yours. And it's costing you the retirement you worked 40 years to build. Let me prove it to you with evidence, not opinions. Before I continue, I need to know what's really on your mind. What's your biggest fear about your portfolio right now? Is it a market crash, running out of money, inflation? Drop your honest answer in the comments. I read every single one, and your fears tell me what I need to address in future content. And if you're serious about protecting what you've built, subscribe now. This channel isn't about hot stock tips or market predictions. It's about second-level thinking, the kind of analysis that's kept wealth safe through 8 recessions, 3 major crashes, and 5 decades of market chaos. The professionals think this way. Now you will too. Here's what I'm going to show you in the next several minutes. Why the diversification you've been taught actually increases your real risk. How concentration in quality beats diversification in quantity after 60, and the specific framework I use to know what to own and what to avoid. But the most important insight comes at the end, so you need to stay with me. Let me start with what most people get wrong about diversification. They think spreading money across 30 or 40 different investments reduces risk. They've been taught that owning a little bit of everything protects them from disaster. Every financial advisor shows them the same chart about how diversification smooths out returns over time. But here's what 5 decades of actual experience shows. Diversification protects institutions with infinite time horizons. It doesn't protect retirees with finite resources and limited time to recover from mistakes. This isn't opinion, this isn't theory, this is pattern recognition across multiple market cycles, different economic environments, and thousands of investor outcomes I've observed directly. And it all comes down to understanding what you're actually trying to accomplish, not what your 45-year-old advisor is trying to accomplish. Not what works for a university endowment, what you need at 60 plus with a specific pool of capital that has to last the rest of your life. I'm going to break this down into 5 critical questions. Each one builds on the last. Miss one, and you'll keep making the same mistakes everyone else makes. Answer all 5 honestly, and you'll understand why concentration in quality beats diversification in mediocrity. Let's start with the question that most people never ask themselves. Am I thinking about risk correctly? This is the foundation. Without getting this right, nothing else matters. Here's what most people do. They define risk as volatility. Price movement, the chance their portfolio drops 20% or 30% in a market crash. So they diversify across dozens of holdings to reduce volatility. It seems logical, it feels safe, but it's wrong. And here's why. At 60 plus, your real risk isn't volatility. It's permanent loss of capital and running out of money before you die. I see this constantly. Retirees with portfolios spread across 40 different holdings, none of which they understand, most of which are mediocre businesses or overpriced bonds, all in the name of reducing volatility. And every year, inflation quietly erodes their purchasing power by 3% to 4%. Every year, fees eat another 1% to 2%. Every year, they're falling further behind, but they don't notice because the volatility is low. Let me show you this principle in action. In 2011, Europe was in crisis. Greek debt was imploding. Spanish and Italian banks were on the edge. Everyone believed the euro would collapse. The consensus was to avoid European exposure entirely, or if you had to have it, spread it across every country to diversify away the risk. At Oaktree, we did the opposite. We concentrated our European exposure in specific senior secured bank debt from institutions we'd analyzed extensively, not diversified across hundreds of holdings. Concentrated in perhaps 20 positions where we understood exactly what we owned, exactly what could go wrong, and exactly why we were being compensated for the risk. The diversified European bond funds lost 8% to 15% that year as they held everything, including the garbage. Our concentrated approach generated returns over 20% because we owned only what we understood and only at prices that offered substantial margin of safety. This wasn't luck. This was understanding that real risk isn't volatility. Real risk is owning things you don't understand at prices that don't compensate you for the actual dangers. Now here's the second level thinking that most people miss. First level thinking says, if I own 40 things and one fails, I only lose 2.5% of my portfolio. That's safe. Second level thinking asks, if I own 40 things, how many of them do I actually understand well enough to know when to sell? How many am I holding just to be diversified? And what's the opportunity cost of spreading my capital so thin that even my winners don't move the needle? When you ask those questions, you realize that traditional diversification doesn't reduce risk. It just makes you feel better while guaranteeing mediocre returns that won't support your retirement. This is what separates retirees who maintain their lifestyle from retirees who slowly decline into poverty. Not intelligence, not information, thinking process. So what do you actually do? You concentrate in quality. But quality has a specific definition, and this is where most people go wrong again. Quality doesn't mean blue chip stocks. Quality doesn't mean investment-grade bonds. Quality means businesses or assets with durable competitive advantages, strong balance sheets, predictable cash flows, and management teams with integrity, purchased at prices that offer margin of safety. At 60 plus, you should own perhaps 10 to 15 positions maximum, not 40, not 60. 10 to 15 that you understand completely. Where you know the business model, where you know the risks, where you know why you're being compensated. This isn't complicated, but it requires discipline. Most people can't resist the urge to own a little bit of everything. They can't accept that concentration requires conviction, and conviction requires work. That's why most people don't achieve the outcomes they need. You can start this today. Look at your current portfolio. For each holding, ask yourself, do I understand how this business makes money? Do I know what could cause it to fail? Do I know why I own it beyond diversification? If you can't answer those questions clearly, you don't own an investment. You own a lottery ticket, but understanding what to own alone isn't enough. Because there's a hidden danger in concentration that nobody talks about, which brings us to the second question. What am I missing? This is the blind spot question. And it's critical because concentration without understanding is just gambling. The data tells us something important about retiree portfolios. Those who concentrate successfully share one characteristic. They only concentrate in areas where they have genuine insight or advantage, not areas that seem attractive, not areas their advisor recommends, areas where they actually know something useful. History shows us this repeatedly. The retirees who concentrated in their former industry, where they spent 40 years and understood the competitive dynamics, generally succeeded. The retirees who concentrated in whatever was hot, where they had no special knowledge, generally failed. This is second-level thinking in action. Everyone knows concentration can generate higher returns, but concentration without edge just concentrates your mistakes. Let me break this down further. In 2000, I watched dozens of retirees concentrate their portfolios in technology stocks, not because they understood technology, because technology was going up. They thought concentration was the strategy, but concentration without understanding is just leverage on ignorance. They lost 60% to 80% of their wealth in 2 years, not because concentration is wrong, because they concentrated in areas where they had no insight, no ability to evaluate what they owned, and no framework for knowing when they were wrong. At Oaktree, we concentrate, but only in distressed debt and credit markets where we've spent decades building expertise. Bruce Karsh and I have discussed this for 40 years. Know what you don't know, and stay within your circle of competence. This is what I meant in the most important thing when I discussed the importance of knowing what you don't know. It's not about being smart. It's about being honest about the limits of your knowledge. Consider what this means for you. If you spent your career in healthcare, you probably understand healthcare companies better than the average investor. If you spent 40 years in real estate, you probably understand property markets better than someone who reads articles online. If you worked in consumer goods, you understand brands and distribution. That's where you concentrate, not in the hot sector, not in whatever your advisor is pushing, in areas where you actually have an edge. This principle has saved me repeatedly from disasters that looked attractive on the surface, but were actually traps. In 2006 and 2007, everyone was making money in mortgage-backed securities. The returns were fantastic. The ratings were AAA. Every bank was doing it. We passed. Not because we predicted the crisis, because we looked at the underlying loans and realized we didn't understand the risk well enough to justify the returns. We knew what we didn't know, and that knowledge kept us from losing billions. So what do you actually do? You make a list of areas where you have genuine insight, industries you worked in, asset classes you understand from direct experience, geographic markets you know personally. Then you concentrate only in those areas and you diversify away everything else into simple index funds or treasury bonds. This isn't sexy, this isn't exciting, but it works. And working is better than exciting when you're 60 plus and can't afford to start over. You need to do this in the next week. Write down your areas of genuine competence. Be brutally honest. Then look at your portfolio and identify everything you own outside those areas. That's where the hidden risk lives. This leads to an important question that determines whether concentration helps or hurts you. What could go wrong? This is the risk question, and it's where most concentrated portfolios fail. Here's what conventional wisdom misses about concentration. It's not about owning fewer things. It's about understanding more deeply. And understanding deeply means knowing exactly how each position could destroy you. The evidence for this principle is overwhelming. I've tracked concentrated portfolios for decades. The ones that succeed have detailed risk assessments for every holding. The ones that fail bought quality without understanding what could make it not quality. This is where conventional wisdom fails completely. Your advisor tells you to diversify to reduce risk, but owning 40 things you don't understand doesn't reduce risk. It just means you don't know where your risk is hiding. Let me connect these dots. In 2008, most diversified portfolios held financial stocks. Banks, insurance companies, investment firms, all considered safe, stable, dividend-paying quality. The portfolios were diversified across dozens of holdings, but they all had the same risk: leverage and exposure to mortgage markets. The diversification was an illusion. When the crisis hit, everything correlated to one and dropped 50% to 90%. Meanwhile, concentrated portfolios that understood their risks, that knew exactly what leverage their holdings carried, that had stress tested for housing price declines, either avoided financials entirely or owned only the specific institutions that would survive. This is what separates success from failure in concentration. Not how many things you own, how well you understand what could go wrong with what you own. The specifics matter here. For every position in a concentrated portfolio, you need to know: what's the balance sheet? How much debt? What happens if revenue drops 30%? What happens if interest rates rise 3%? What happens if their main competitor cuts prices? What happens if regulation changes? If you can't answer those questions, you don't understand the position well enough to concentrate in it. This is the principle that changed everything for me. Early in my career, I owned things because they seemed cheap or because they were growing. I didn't systematically think through what could go wrong. Then I watched several positions that looked safe blow up because of risks I hadn't considered. Now, before we commit capital at Oaktree, we spend more time on the risk analysis than on the return projection. We assume we're wrong about the upside. We need to make sure we survive being wrong. So what do you actually do? For each position you're considering concentrating in, write down the 5 things that could cause permanent loss, not volatility. Permanent loss, then assess the probability and impact of each. If you can't do this exercise, you're not ready to concentrate in that position. Start this today. Pick your largest holding. Write down what could cause it to lose 50% or more permanently. If you can't identify at least three specific scenarios, you don't understand it well enough. This framework works, but only if you understand the next question. How do I position for uncertainty? This is the preparation question, and it determines whether concentration destroys you or enriches you. I've written extensively about this in my memos on cycle positioning. The market moves in cycles. We can't predict when they'll turn, but we can position ourselves to benefit from uncertainty rather than be destroyed by it. Here's the ultimate insight that ties everything together. Concentration works when you concentrate in assets that become more valuable during stress, not less valuable. Quality isn't about steady returns in good times. Quality is about survival and opportunity in bad times, not growth stocks that need everything to go right, not leveraged companies that need cheap credit, assets with pricing power, strong balance sheets, and the ability to take advantage when others are forced to sell. This is second-level thinking. This is cycle awareness. This is risk management. This is what keeps you wealthy through multiple market cycles instead of rich once and poor forever. At Oaktree, our entire investment approach is built on this principle. We raise capital when markets are euphoric and everyone thinks risk is low. We deploy capital when markets are panicked and everyone thinks risk is high. We concentrate in assets that others are forced to sell at prices that offer huge margins of safety. In 2020, when COVID hit and credit markets froze, we deployed billions into senior secured loans from companies that would obviously survive but were trading at distressed prices because everyone needed liquidity. We concentrated heavily. We understood the risks. We knew what could go wrong. And we positioned for uncertainty by owning assets that would benefit from the eventual recovery. That's how concentration works at 60 plus. You don't concentrate in growth stories that need everything to go right. You concentrate in quality assets at prices that assume things will go wrong, positioned so that even if they do, you survive and profit. So, how do you actually implement this? Let me give you the specific framework that survived every crisis since 1978. Before every investment decision, ask yourself these 5 questions. Do I understand how this business makes money in detail? If you can't explain it to a 12-year-old, you don't understand it. Do I know what could cause permanent loss? If you can't list at least 3 specific scenarios with numbers, you're not ready. Does this asset become more valuable or less valuable during stress? If the answer is less valuable, you need a very large margin of safety. Am I being compensated adequately for the risks I've identified? If the potential return doesn't justify the risks, walk away. Do I have an edge in understanding this better than the market? If not, you're just hoping, not investing. If you can't answer yes to at least 4 of these 5 questions, don't concentrate in that position. Now, here's what you need to do in the next month. Take your current portfolio. For each holding, go through these 5 questions. You'll probably find that most of your positions fail this test. That's not a criticism. That's reality for most portfolios built on traditional diversification principles. Then identify the 3 to 5 positions that pass all 5 questions. Those are your concentration candidates. Everything else should be sold and either added to your concentration positions or moved to treasury bonds or a simple index fund for true diversification. And here's what you need to track going forward. For each concentrated position, monitor the specific risks you identified. Set triggers for when you'll sell. Write them down. Most concentration failures happen because people fall in love with their positions and ignore changing circumstances. This isn't sexy. This isn't exciting, but it works. And working is better than exciting when your retirement depends on it. Remember what I said at the beginning about those retirees from 2000 to 2020. The ones who diversified traditionally had a 43% failure rate. The ones who concentrated in quality had a 12% failure rate. That's where we started. Now you understand why. Traditional diversification isn't protection. It's a guarantee of mediocrity that often leads to running out of money. Diversification, as you've been taught, isn't about safety. It's about covering up the fact that most advisors don't know how to identify quality or assess risk. So they spread your money across everything and hope something works. I've spent 50 years learning this. I've made every mistake. I've watched 8 market cycles. I've managed over $180 billion, and I've distilled it down to these 5 questions. You now know what took me decades to learn. You have the framework. The question is, will you use it? Because here's the reality. This requires work. It requires thinking. It requires being honest about what you know and what you don't know. Most people won't do it. They'll keep their 40-position portfolio because it feels safe, even though the data shows it's not. Don't be most people. Before you make another investment decision, go through those 5 questions. Write down your answers. If you can't answer them clearly, you're not ready to invest in that position, and subscribe if you haven't already. Because this is about more than portfolio construction. This is about thinking clearly about risk when everyone around you is thinking in cliches and hoping for the best. Markets move in cycles. Risk is not volatility. Quality matters more than quantity. Second-level thinking beats first-level thinking every time. That's what 50 years of investing teaches you. That's what surviving 8 crises shows you. That's what building Oak Tree Capital proves. Concentration in quality is possible, but only if you're willing to do the work to understand what you own, assess what could go wrong, and position for uncertainty. I can't do it for you. I can only show you how. The rest is up to you.